So during the thought process, I had observed that there are some certain ways through which the hotel can be valued at. Okay, so the first method, as we all know, is land and building method. So land by market approach and building by cost approach, that I have already carried out. The next method, again in the market approach or based on some thumb rule method, would be try to analyze the uh, the cost or value of per room basis. So let's say there are similar three-star hotels in the vicinity or in that city, and the per room cost of the similar three-star hotels or a five-star hotel can be estimated, and based on that, after upon having certain adjustments related to the location advantages and disadvantages, we can arrive at a number for the subject hotel property and just multiply with the rooms that are there in the subject property. So that will give you the hotel valuation. So this is the first kind of a methodology that we can have, and we can judge it based on the historical data, based on the past data, and upon having certain basic adjustments related to the locational advantages and disadvantages. So that is the one factor. But again, I was not completely satisfied with this rule of thumb methodology. Uh, However, just to prove certain points or certain aspects, yes, we can we can use this tool for a comparative analysis purpose. The next aspect was again related to the capitalization of income. So under income capitalization or under income approach, there are two ways by which we can carry out the valuation. So one is based on DCF, discounted cash flow technique, which I'm not going to discuss it today because it will go beyond 2 hours topic, and that DCF technique itself will require at least 2 hours to discuss the valuation. So I'm not going into a DCF valuation. However, the DCF valuation requires the future cash flow generation ability of that particular hotel property. And based on that, we will adopt one capitalization rate, and then we will discount our future cash flows, explicit cash flows, as well as the terminal cash flows. And then based on that, one value will get, we will get one value. So this is the basic fundamental behind DCF. However, related to the residual approach, I have found out a write-up which is there in Mr. Shamal Zatta book. And I have found out that it is pretty much interesting to learn from that particular angle. So, while what it says, so that particular the residual approach or residual approach in income statements, that is purely based on your historical statement, historical profit and loss statement. So based on that analysis, the hotel valuation can also be carried out. So here the only point is to understand the concept related to that income generation. Okay, so here is the flow chart that describes the entire process and how that particular valuation is assessed with the help of the income generation. So now what I did is I had asked them to provide me past historical data, the profit and loss statement, and from that profit and loss statement, I tried to extract the different numbers. So these different numbers are gross sale amount for past 3 years, the total purchases that the hotel owner have made. Now, gross sale would be from hotel rentals, room rentals, the banquet hall rentals, food, uh, the other incomes that the hotel may be generating through direct sales. So, all those aspects were considered in the gross sale. So every year, how much amount of gross sale they were making, that we have identified. Technically, in 2020, the sale was very less. In 2019, there was some sale. In 2021, again, the sale was not at great extent. However, in 2022 and part of 23, they had got good amount of sales. So that was considered in the valuation. Then we have also considered the purchases. So herein the purchases would mean the direct purchases that the uh, hotelier have made. So purchases could be in the form of food, beverages, the item purchases that are required for running of the restaurants, hotels. So all those purchases were deducted from the gross sale. Then the difference of these two number gave me a gross trading profit. So this, why this is called as trading profit is because uh, the number which is a trading profit, rather it reflects the uh, it rather reflects the actual profit that has come from the trade. So trade of rooms, trade of the banquet halls, trade of some the business halls, uh, the trade of tables which are there in the restaurant. So based on that, the number is arrived at. Now from this, the working expenses are deducted. So working expenses are like the wages, salaries, wages, and predominantly it will form wages and salaries. So all those expenses which are required to run the hotel will be turned under the working expenses. So these working expenses are deducted from the trading profit to get the net adjusted profit. Now, from this net adjusted profit, we get uh, we have to deduct the return on tenant's capital. So let's say the capital expenditure in constructing the building is made by the company, hotel company, and those uh, numbers, the tenant capital, or let's assume that the number is 30 crore rupees. So he had spent 30 crore rupees for constructing the entire hotel building. Now, he would expect certain return on account of the construction, capital spent on the building. That particular number, again, there will be plant and machinery, working capital. So all those expenses would be there in the tenant's capital. Now, from that tenant capital, he would expect, let's say, every year 10% or 15% return over the tenant's capital. So if let's say for an example, let's say I have a profit of 5 crore rupees in first year uh, upon selling or giving my rooms on rental, and upon having the business in the hotel. Let's assume that I have 5 crore rupees profit in the first year. But if I take out entire 5 crore rupees, let's and my investment is 30 crore rupees. Okay, so if I take out entire 5 crore rupees profit from that organization, it will be difficult for that organization or company to sustain into the business. They will not be able to meet the uh, expenses or the business requirements in the coming year. So here, in the next year rather. So that's why normally, if 30 crore rupees is invested, 10 crore rupees or 10% of 30 crore, that is 3 crore rupees, can be extracted, can be taken out from that profit. Okay, so every year, so within 10 years, every year 3 crore rupees, if I take out, then whatever capital that is invested by the hotelier will get recouped. So that is the intention. So that particular number will get deducted over here. Now, uh, the balance number after deducting the tenant's capital would be termed as a divisible balance. Now, why this number is termed as divisible balance? Because if we look at the flow chart, from gross sale, we have deducted all purchases, we have deducted all working expenses, we have also deducted the return expected by a hotelier on his capital investment. So that is also deducted. So most of the expenses are deducted from the gross profit, sorry, gross sale. So the balance number is termed as a divisible balance, and it has got two components. So one component would be in the form of tenants or hotelier share, and another component will be landlord share. Okay, so here the number gets split into two parts. Now, why this divisible balance is actually a residual profit. This divisible balance can also be termed as a residual profit. The last number which the hotelier will have in his hand. However, that particular number has got two components. So, because why this particular amount he has recovered is because two things. One is goodwill, and another is on account of his asset, land and building. So locational importance of the land, the building, aesthetics, views, the particularly aesthetics, how the hotel is placed, how the interiors are made, how attractive it is to the customer, and the location. That means whether it is in close proximity to a business areas, a central business depot areas, uh, or it is close to the let's say the environmentals or any tourist attraction spot in the city. So based on that, the hotel selection would take place. So there is an element of goodwill as well as the asset that we are valuing. So that's why the divisible balance will get split into two parts. Now here, uh, again, there are certain set of assumptions over here. Now, divisible balance. Let's say if the amount is 1 crore rupees, this divisible balance is 1 crore rupees. So out of 1 crore, how much? Sorry, how much amount is earned through goodwill, and how much amount is earned by that particular building. Now, to justify that particular number is slightly difficult. So, normally, what needs to to be assessed over here is how that percentage distribution shall take place. So here again, we will have to compare the goodwill component and the rental components or land and building value component from the market perspective. So again, market approach dynamics will play a vital role.